Greetings, future investors. Welcome to our journey into the fascinating world of stocks. Today, we're exploring the foundational principles of the stock market. It's crucial for anyone looking to dip their toes into this exciting realm of investing to grasp these basics. You see, stocks represent ownership shares in companies. When you buy a stock, you're essentially buying a piece of that company's assets and earnings. This ownership is traded in places we call stock exchanges. But why invest in stocks, you may ask? Well, stocks offer the potential for long-term wealth growth. Historically, the stock market has provided substantial returns, making it a compelling part of a diversified investment strategy. Before diving in, there's a lot to consider. Research, choosing a broker, understanding your risk tolerance, and building a diversified portfolio are all key steps to take when starting your investing journey. So buckle up as we begin our exciting voyage into the world of stock investing. First off, what are stocks? Simply put, they're ownership shares in a company. Yes, that's right. When you buy a stock, you're purchasing a tiny slice of that company. You might be wondering, how tiny exactly? Well, it depends on how many shares the company has issued. Some companies have millions of shares, others have billions. But no matter how small your slice, as a shareholder, you have a claim on part of that company's assets and earnings. Let's break it down a little. When we talk about a company's assets, we're referring to everything the company owns that has value. This could include their office buildings, factories, equipment, and even the products they have in stock. Earnings, on the other hand, are the profits that the company makes. When you own a stock, you have a right to a portion of these assets and earnings. Now, you might be thinking, great, I own a piece of a company, but what does that actually mean for me? Well, as a shareholder, you often have the right to vote on important company decisions. This could include electing the board of directors or approving a merger. You might also receive dividends, which are a portion of the company's profits paid out to shareholders. However, it's important to remember that owning stocks isn't without its risks. If a company doesn't perform well, its stock price could fall, and you could lose money. On the flip side, if the company does well, the stock price could rise and you could make a profit. That's the risk and reward dynamic of investing in stocks. But where do you buy these stocks? That's where stock exchanges come into play. A stock exchange is a marketplace where buyers and sellers trade stocks. Some of the most well-known stock exchanges include the New York Stock Exchange and the NASDAQ. Companies list their stocks on these exchanges and investors buy and sell them during trading hours. It's kind of like a farmer's market, but instead of buying and selling fruits and vegetables, you're trading shares of companies. And just like at a farmer's market, prices can fluctuate based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. One final point to note is that not all stocks are the same. There are different types of stocks, each with its own set of characteristics. For example, common stocks are the most prevalent type of stocks that investors buy. Owners of common stocks can vote at shareholders' meetings and receive dividends. Then there are preferred stocks, which don't usually come with voting rights, but they have a higher claim on profits and assets. This means that if the company pays dividends, preferred shareholders are paid before common shareholders. So when you buy a stock, you essentially become a part owner of that company. You get a claim on their assets and earnings, the right to vote on company decisions, and maybe even a share of their profits through dividends. But remember, with these potential rewards come risks. The value of your stocks can go up or down depending on how the company performs and what's happening in the market. That's why it's important to understand what stocks are and how they work before you start investing. That concludes our deep dive into understanding stocks. As we've seen, stocks represent ownership in a company and come with certain rights and potential rewards. But they also come with risks, and their value can fluctuate based on a variety of factors. In our next section, we'll explore why people choose to invest in stocks and what potential benefits they offer. So stay tuned. Now, you might be wondering, why should you invest in stocks? Well, the answer lies in the magic of compounding and the potential for long-term wealth growth. When you invest in stocks, you're essentially buying a piece of a company's future earnings. Over time, as the company grows and profits, your investment also grows. Historically, the stock market has delivered an average annual return of around 7% after inflation, making it an attractive investment avenue for wealth accumulation. Moreover, stocks can be a crucial component of a diversified investment strategy. By mixing different types of investments, you can spread your risk. If one investment performs poorly, another might do well, balancing out potential losses. So, in essence, stocks offer the potential for significant returns over the long term, and when combined with other types of investments, they can help you build a robust and resilient portfolio. Indeed, stocks have the potential to be a key player in wealth creation. So, how do you get started with stock investing? First off, research is key. You wouldn't buy a car without knowing its make, model, and mileage, would you? The same principle applies to stocks. Familiarize yourself with financial news, explore investment websites, and delve into company reports. Understanding a company's fundamentals is crucial before you invest. Your next step is to choose a broker. To buy and sell stocks, you'll need a brokerage account. Online brokers are a great starting point due to their accessibility, especially for beginners. Look out for low fees and a user-friendly platform that suits your needs. Now let's talk about risk tolerance and setting goals. It's essential to assess how much risk you're comfortable taking on. Your goals and investment horizon should guide your stock choices. And remember, diversification is not just a buzzword, it's a strategy to manage risk. Remember, a well-prepared investor is a successful investor. Now that we've covered the basics, let's talk about building your portfolio. A portfolio is simply a collection of various investments. It's like a financial wardrobe filled with different pieces to suit different occasions. Diversification, or spreading your investments across a variety of asset classes and sectors, is the equivalent of having both t-shirts for the summer and coats for the winter. Allocating your investments across sectors such as technology, healthcare, or energy can help you weather the ups and downs of the market. It's like not putting all your eggs in one basket. If one sector suffers, another might thrive, balancing out your portfolio. But remember, every investment comes with a risk-reward trade-off. Higher potential returns often mean higher risk. So it's crucial to assess your comfort with risk and align your portfolio accordingly. A well-diversified portfolio can be your best defense against market volatility. It's about creating a smart mix that can help you reach your financial goals while keeping your peace of mind. Ready to take action? Let's delve into stock selection, buying stocks, and monitoring your portfolio. Stock selection involves two key types of analysis: fundamental and technical. Fundamental analysis is about understanding a company's financial health and growth potential, examining factors like earnings, dividends, and industry position. On the other hand, technical analysis focuses on trends and patterns in stock prices. Once you've selected your stocks, it's time to buy. This is done through your brokerage account, where you place orders. There are different types of orders, such as market orders, where you buy at the current market price, limit orders where you set a specific price, and stop-loss orders to limit potential losses. Finally, don't just set it and forget it. Regularly review and adjust your portfolio. Stay informed about market trends and how your stocks are performing. Remember, successful investing is a proactive process. And there you have it, stock market basics in a nutshell. We've covered a lot of ground in a relatively short amount of time, and I applaud you for staying with us throughout this journey. We started at the very beginning, defining what stocks are. They represent ownership shares in a company. When you buy a stock, you're essentially buying a piece of that company's assets and earnings. We also introduced you to the concept of stock exchanges, where these stocks are bought and sold. We then delved into the reasons why investing in stocks can be a viable strategy for long-term wealth growth. We highlighted the historical average returns of the stock market and explained how stocks can be a part of a diversified investment strategy. Remember, diversification isn't just about spreading your investments across different companies, but also across different sectors and asset classes. Next, we walked you through the initial steps you need to take to start your investing journey. We emphasized the importance of doing thorough research before making any investment decisions. This research can be done through various sources such as financial news, websites, and company reports. Understanding a company's fundamentals is key to making informed investment decisions. We also discussed the importance of choosing the right broker. You'll need a brokerage account to buy and sell stocks, and today's online brokers make this process accessible even for beginners. But remember, while an easy-to-use platform is important, you should also consider factors like fees. We moved on to assessing your risk tolerance and setting clear investment goals. These factors will greatly influence your stock choices. We also talked about the importance of diversification in managing risk. Remember, it's not about putting all your eggs in one basket, but rather spreading them across several baskets to mitigate potential losses. Then, we turned our attention to building your portfolio. A portfolio is simply a collection of your different investments. We discussed the concept of risk-reward trade-off and how it plays a crucial role in your investment decisions. The idea is to balance your desire for high returns with your ability to endure potential losses. In the next part of our journey, we discussed taking action. We introduced the concept of fundamental and technical analysis and explained how these tools can help you evaluate a company's financial health and growth potential. We also discussed how to place orders and buy stocks through your brokerage account. We introduced you to different types of orders like market orders, limit orders, and stop-loss orders. Lastly, we stressed the importance of regularly monitoring your portfolio and staying informed about market trends. Keep in mind that investing is not a set-it-and-forget-it type of activity. You need to be proactive in managing your investments, making necessary adjustments as market conditions change. These are the key takeaways from our discussion today. They represent the foundations of stock investing, but remember, this is just the beginning. There's a whole world of investing knowledge out there waiting for you to explore. I encourage you to continue your learning journey, to seek more in-depth resources, and to never stop asking questions. As we wrap up, I want to remind you that investing in the stock market is not a get-rich-quick scheme. It requires patience, discipline, and a willingness to learn. But with the right approach and mindset, it can be a powerful tool for building wealth over the long term. Remember, knowledge is power, especially in the world of investing. So keep learning, stay invested, and see you in the next video.